Hello, everyone. My name is Lucian. Most of you know me from Twitter as Triangle Investor. In today's edition of CEO and Market Expert Interviews, I am delighted to have returning guest who needs no introduction, and that is Mike Alkin. Mike, thank you for coming, and as always, it is great to have you.
Hey, Lucian, my pleasure. Thanks for having me.
Thanks for coming. Mike, you and your company are present in majority of segments on the uranium market. You are invested in equities and physical uranium. I want to touch on physical uranium part first. Give us your inside look of things on the uranium market. Is the tight uranium market now even more tighter than from the last time you and I spoke in August?
Yeah, since August, yeah, I would say so, very much so. And there's two uranium markets, right? There's the spot market, and there's the term market. And for those listeners who might not be familiar with the difference, the spot market historically is where maybe 15 to 20% of pounds trade in a given year over many, many years. Sometimes, though, it's much more than that. And when I say it's of annual consumption. And when there was a surplus, it could have been 2/3 of the pounds, or 50% of the pounds, or pounds traded there. But mostly it's a market driven by long-term contracts, 7, 8, 10, 12 years. But the spot market is where daily price reporting occurs. So that's where people tend to focus on, and that's where traders conduct their business. Most traders are not party to long-term contracts simply because security of supply is paramount to a utility, and that trader can't, in most cases, provide that because they don't produce it. Yep. So traders typically play in the spot market, and they trade. They try and get some offtake. They'll try and get some agreements with producing mines and take some. They'll take it. They might sell into a short-term contract with the utility, or they might try and trade it to other traders in the market for a little bit of a rise in price. So what we're talking about here is the spot market. The spot market, we buy physical uranium, and so we are in the market every day, and it's an opaque market, right? It's an over-the-counter market. The price that you're seeing at the end of the day, when the price reporters, a few of the different ones, will put it out, or a couple of brokers put their price out, it's the bid and the ask, and it's the midpoint of that. They do have a little discretion sometimes, because in the West you have a few different places. You have 3 different conversion facilities that store uranium. So some might carry a little bit more of a premium, 25 cents, 50 cents, 75, $1, depending on who needs material where. When we are in the market every day, we're looking for what's happening. We're out talking to the traders, we're talking to the uranium brokers to see what's going on. And to put some context around it, is there are some days recently in the last couple of months where there are no offers, which means that the physical traders don't want to sell you the uranium, right? And I've talked about this for years in the commodity. When prices rise, it becomes more dear. Right, and so they're going to hold on to more prices, and also, it's a show me market. The physical traders, their time horizon is a couple of weeks to a month. It's not what you and I look at, which is structural deficits. Structural, over how many years, right, per annum can economic supply meet consumption? That's a foreign land to them, right? They don't play in that world. It's what's there in the next couple of weeks. So that market is tight. There are days where we can't get offers. There are days where the offer is much higher than the bid, and it starts to spread out. And what you're seeing is, in the ethos, in the trading circles, if you will, amongst the traders, amongst the brokers, they've continuously waited for the next $5 you're going to see a lot of supply. And they've been saying that since 50, since 45, since 50, since 55. There's the old saying, bull markets climb a wall of doubt. You keep seeing that, but yet the material's not coming out. And so there are some shorter term RFPs in the market from utilities. So some traders go out and try and get ahead of that and get some. I've seen people say, the market is characterized, well, Sprott is the one that is moving it. it's the financials. No, it's not. Sprott has been basically irrelevant this year. The big physical trust, they bought it some hundreds of thousands of pounds, but this is demand coming from elsewhere. It's coming from other financials. It's coming from traders who see RFPs coming out. It's coming from some utilities. It's coming. It's there. So yeah, it's very tight. You know, I'm trying to think. We last bought 3-4 weeks ago. No, somewhere around there. We bought maybe a month before there. We bought some. So we're not, you know, we pick and choose where we want to buy our pounds. But as having a look into it every day, it's very tight.
Yeah.
So yeah.
So long story short, like you said in my prior interview, do you still believe that the spot market is a bullshit market, or there are more legitimate utilities?
It is. It's, you know, the market. So there are times where it's not, right? So when there are excess pounds post an event like a Fukushima, and the market becomes oversupplied, that's a place to clear those uncommitted, uncontracted pounds. And, you know, like this year, I think 54, 56 million pounds have traded there. In the spot market, last year it was 56 or so. The year before, it was almost 100 million pounds that traded there. So you were still working through some excesses, and they keep getting worked down. But that price, though, you know, when there was 100 million, prices were still moving higher.
Yeah.
So but at some point it turns from a buyer's market to a seller's market. Seller's market being you're a producer trying to sell to a utility, and now price is on your side. You start to see the spot price move up, which then carries the term contracting, even though they're different things, right? If you think about spot market being 15% or 20% typically over cycles, it shouldn't drive productive economics of long-term contracting, but psychologically it has an impact. It has an impact on fuel buyers. It has an impact on investors, on traders. They follow price. There are very few people. I mean, I started investing in this space when it was low 20s, and right, we're at 80 now. And I've been told all the way up how wrong we are. As it's quadrupled, they only respond to price movements. Nobody, I mean, we were talking to fuel buyers and traders way back then, and ad nauseum, and nobody really wanted to buy low. There was a fuel buyer. A fuel buyer who people will probably know out there that was buying uranium. Those who really follow it closely on Twitter, if they will. Years ago, a guy approached us. We spoke at a conference, a Nuclear Energy Institute conference in October of 2019, I think it was. And there was one fuel buyer who approached us, and he said, "I agree with your thesis. You should be buying now, and I'm buying now." And he secured a lot of uranium for his. But most just follow price.
Yeah. Mike, let's touch a bit on the quantity numbers on the spot market. Do you have any information on the amount of pounds available for sale in the spot market? I mean, what volumes could you secure, for example, like you said, 30-day delivery, and what kind of volumes have become mission impossible?
Just the other day, one of the very large traders that is a well-known entity in the world, let alone talking to the traders, and we wanted delivery for the next 30 to 60 days, and they had nothing. They had nothing to show us. They said they could go out into April for a couple of 100,000 pounds. April, May, recently in that time span of talking with them, maybe go out to June. But we're talking a couple 100,000 pounds, nothing more. I wanted 30, 60-day delivery from them. I couldn't get it, and they typically have it. Now, somewhere along the way, one of these guys might get an offtake for a couple 100,000 pounds, 150, 100, 200, 300. Maybe they'll try and sell it, but on the day-to-day, you're not seeing it.
Yeah. You said about RFPs. It was a busy quarter for RFPs. How do you see the quantity of RFPs in the next 6 months, and from where will they come from?
So it's a good question, Lucian. A lot of what gets transacted doesn't come via RFPs, and so the market focuses on RFPs. And again, in a world where there's so little information, where there's any information, people focus on it, right? So whether it's spot price daily or RFPs, but RFPs serve a psychological role. It shows other fuel buyers and traders activities taking place, right? And there's a tremendous amount of FOMO that occurs, right? Fear of missing out. So the RFPs inform the market that there are people looking, right? So there's real demand. But when you start to see them start stacking up on top of each other, that even is more. But what's really happening is the private bilaterally negotiated contracts amongst producers. That's where the rubber really meets the road. But the RFPs are a good indication of that, because it then stimulates the fuel buyers to go in and start doing that.
Yeah, definitely. Mike, we are hearing that agreements, long-term agreements with ceilings and floors have already $100 plus uranium ceiling in them. And as far as the floor price, that we are seeing some high 60s, low 70s. Is that the case? And how do you see those pricing going forward?
Yeah, so if you're a utility, you'd like to get a base escalated price, a base price plus mild escalators, inflation adjusted, and all that stuff. I mean, that's for the last several years, that was their game, right? That is not a game. That's a buyer's market. Now, if you're a producer, you want market related contracts, and you want I want to recognize the price at time of delivery in the future, because I think it's going to be higher with a floor and a ceiling, right? So ceilings, we have heard, and from our due diligence, that approaching, if not in or a little above or below triple digits, $100. Floors can be high 50s, mid 60s, depending on the contracts, right? Because you can't take a data point. It could be, right? And I know you know that, but it could be, what did they get in return? Did they get different flex up or flex up options, or did they limit how much the utility could flex up and they gave them a few more dollars? Did they get a couple of extra years? Right. So they're all bilaterally negotiated. So, but clearly, floors and ceiling, I mean, the downside, it's all right. In investing, we look at what's my upside versus my downside, right? Risk. Same thing here. If you're a utility, if you're a uranium miner and it's $80 and you're selling at time of delivery, you think it's going to be higher, but your ceiling's $100, 105, pick a number, and your downside's 65. Okay, well, it's $65 uranium, you're doing really well, right? If the world went to hell in a handbasket, you're still, for many of them, you're making money. At $20 more. So now what are you going to start to see? That gap was a little bit wider. So they want to keep widening that gap. They want more upside and less downside. And as it's more of a seller's market, we are in the very early stages of a contracting recovery. To put it in context, and this is where the negotiations come into play. And I've said this before, and I'm sorry for repeating it, but it really informs where this market is, I think, and where it's come from. And we study as much as the past as we do the present, the work in the present. And the past was from a 92, 3, 4 to 04 was a lull in the market contracting. About 35% of all annual consumption in a reactor was replaced via long-term contracts. And then when the bull market kicked off in 05 to really 2012, even though Fukushima was 2011 in March, you saw that period of time where where contracts were as 110 to 135, 40% of annual consumption. Why? They had to restock. They had to buy for their consumption and then restock above it. The exact same thing has happened here. Since 2012 onward, you had about 36, 37%, and now you're back into, so now this year, you're at 153 to 5 million pounds of contracting versus 114 last year versus 70 the year before. Used consumption for this year, 180, 190, depends what reactors got kicked off, new loads and stuff, where the year's already over. But you're getting right there. And so, that you haven't even hit contracting at rates of consumption yet. And then you've got to restock. And then the difference, and I've said it time and again, if you heard this, I'm sure people are saying rolling their eyes, but it's what's so critical is in the last cycle, there was a surplus in the market when the prices in December of 2000 were $7 a pound. By the time Cigar Lake flooded, the big mine that was scheduled to come online in October of 06, it flooded, supposed to come on in 07. The prices were in the 40s. So it had moved up 7x, right? It climbed that wall of doubt. Cigar Lake flooded. If you were a fuel buyer and you looked at all of the available forecasts, the consensus, and you wanted to contract out over the next 6 or 7 years, there was a surplus of over 200 million pounds in the market, 225 million pounds. Yet prices went from high 40s up to 137 for a brief period of time over 8-10 months. Yeah. Today, and at that time, Lucian, you had Kazatomprom ramping production from a very small base, 9 million pounds, supposed to be 19 million. In 05, it was 9 million. The forecast was by 2015, it would be 19 million. By the time you got to 2015, it was 56 million. So the massive rate of change every year that was occurring while contracting was occurring and at much higher prices was significant. And then you also had the megatons to megawatts program of 20 million pounds a year. Yeah. Right. Neither of those exist. We'll talk about Kazakhstan, but people talk about Kazakhstan. Are they going to go to full production? Who cares? It doesn't matter with the deficits. So they add 15 more million pounds. You need a lot more than that. And we could talk, I'm happy to go into detail on that. The rate of change of what they could bring online versus in the past is significantly less. So you're in an environment now where contracting is kicking off, inventories are well below historical norms. You've had a geopolitical realignment taking place. You've gone from enricher excess capacity to what's appearing to be not enough capacity. And in an enrichment world, when there's not enough capacity, you have to use more uranium to extract to feed the reactors. It's called overfeeding.
So, Mike, we will get to there.
So contracting is just starting to kick off right now.
Yeah, just a quick return to your point. We have only a few weeks in this year to go, but can you estimate how many uranium is contracted or will be contracted in total for this year? And what numbers are you projecting for 2024?
Yeah, so, I mean, if you were sitting here, you would see a model that goes on forever, that we've built since 2015, 16, 17, and refine it and refine it and refine it with tabs as far as the eye can see, and all different aspects of it. And that informs us in great detail. But the way I view that is significantly different than that. It's all directional, right? So I don't forecast, I mean, we have forecasts each year on what our numbers are, but for contracting, something like that, Kate, I've said this publicly for many years, the horse left the barn. The horse left the barn in 2018. The horse left the barn a long time ago. Barn door's open, and it's been open, and it's going to keep opening. And so because you can't make up what you didn't do in the past. You let your supplies run low, and now you're competing for it. So it's 156, 153 through last week, maybe. I don't know. So you got to remember, not everyone reports their contracts too. Of course, there's no binding agreement you have to report. So what you might see is can they print a 160 number? Maybe. So next year I would expect it to be significantly higher, because I know the cohort that buys this stuff. And this cohort that buys this stuff, fuel buyers, are really smart nuclear engineers for the most part, who don't believe anything until they see it. And except this one guy I was talking about, and maybe a couple of others, but for the most part, they're not incentivized to buy bottoms. They will chase price. And what I believe is price still has a long way to go to meet the capacity requirements, to meet the demand requirements. So what's the exact number for next year, Lucian? I'm not really concerned about it. I know it'll be higher. I know they're already going to be running up against capacity limits, which is going to drive pricing higher.
Okay, Mike, during 2022, 15% of uranium delivered was purchased under spot contracts. What would you say are the percentages for 2023? Or do you see that number declining over the next few years or rising?
Yeah, no, I think it will decline. I think there's less available. So if, let's say, 2021, I mean, depending on whose forecast you want to, whose numbers you want to look at, I have 180 million pounds, 70 million pounds in demand.
Yeah.
You had 100 million pounds in the spot market, roughly 98 million, 100 million pounds. So this year, if we see 58 million pounds in the spot market on 180, 190, something like that. So it's declining precipitously. If it's based on what we experience on a day-to-day basis in the market, looking for it, I would suspect it's going to be less next year. It's going to be tight. It's going to be much tighter. It's just one more year of tightness, one more period of time in tightness, when which drives prices higher, which brings more participants into the market, more vehicles, more hedge funds, more people who are vying for those very finite amount of pounds. And then utilities, right? So, but utilities, even though they might be sniffing around the spot market now, when they're in a contracting phase, they don't want to be out there going into the spot market and buying big amounts, because it's going to send the price parabolic. They don't want to compete against themselves, because that spot price will drive term pricing. So that's why I think you'll even see more term pricing, because they don't want to be in the spot market as if they can avoid it, and they can't always avoid it.
Yeah, yeah. Do you see maybe some new sellers on the spot market coming soon? Is BHP maybe selling on the spot market?
No, BHP was a big spot market seller for years. When I say big, 8 to 9 million pounds, some years 10. It's a byproduct at Olympic Dam.
Yeah.
We used to sit down with them in 2018 and 2019 at nuclear events and say, "What are you doing? Like, there's deficits forming. Stop selling the spot market." They're like, "Yeah, whatever. It's a byproduct." There was no real interest in doing anything, and now everything we see is they're selling into contracts. Maybe a few drift here or there, but almost for the most part, their philosophy and the way they're going about it has changed. So they're being very disciplined with it, and why not? Even though it's a rounding error for their bottom line, would you rather sell uranium at higher prices or lower prices? If you could get higher prices, take them. And if you could get more security on those pounds of contracts, then take them. And so, yeah, but they're not a difference. It's a few million pounds, Lucian, our deficits, and you could bring out the Kazakhs to full production. You could, in 28, 29, or 29, 30, bring on next gen, bring on the big ones out there, bring the Kazakhs to full production. We're still looking at 30 million pounds plus per annum of deficits. So a couple of million pounds here or there, when you see data points in the market, oh, this one's starting at, this is 800,000 pounds, it's 2 million pounds. So what?
Exactly, Mike. In your estimate, how much of the material is still coming from Russia to Western utilities?
So, it's a good question. In the form of EUP into the US, it's coming. They're taking it, and they will continue to take it in. It's enriched uranium, right? So there's fuel cycle 101, and I'm sure everyone knows this, and they're going to roll their eyes again. Uranium comes out of the ground. It gets crushed into yellow cake. It gets converted to UF6. It gets enriched. It gets fabricated, and then it's in a reactor. But they enrich uranium. They control 41% of the market for enrichment. They sell enriched uranium product. The U.S. could take in 25% of their needs in that. So that's going to come in through 27-ish. There's some bills floating through Congress that want to shut it down, but there's clauses that will put it on 26, 27, 28 if that gets through, and that's okay, right? So it's not it's not about, oh, it's not going to come in tomorrow, because you then have to go out and replace that capacity, and there's been a lack of investment in the enrichment and conversion space for many years. the price of enrichment, SWU, the separative work unit that enriches, was $35 at the bottom in 17. It's now $155. The price of conversion was $4 back then. It's now $45. So why? Because there was a lack of investment. So how much Russian? It depends what material. They're not a big uranium player. They're 14% of world supply. But you've got to look at the world through open market and through what Russia and China sell to. So, when you look at SWU or you look at conversion, I think about it in terms of open versus closed market, open versus closed. And I think about the Russians will, over time, probably the amount of SWU they sell into the Western market, the amount of conversion they sell into the Western market. And so to put that in context, in a SWU market of 60 million SWU, the Russians probably sell into the open market. The Western and some other countries aligned with the West, 7-8 million SWU. I would expect that to go down to 3 million. So, right. So you'll see less there, and then you'll see conversion. Something similar in terms of 50 to 75% reduction in the amount of conversion, the UF6. And again, there's capacity in the West in SWU, in Orano and Urenco that over time will come online. It doesn't happen overnight. It comes online over 3, 4, 5 years. They need the capital commitments from the utilities. And then if you're Orano or Urenco, you own the Enrichment Technology Corporation, ETC. They own 50% of each. That's been like a mine the last 7 years. It's been idle. So now they need to restart it, to make the centrifuges, to hire the skilled welders to do that. That takes a few years. So that's why it's nice to see this gradual transition away. What I can say is we don't know of very many, if any, Western European or US fuel buyers signing new Russian SWU contracts, signing new Russian contracts for anything. So that creates more demand in the West.
Yeah, good point, Mike. Do you see a scenario where countries with big nuclear fleets building a strategic inventory of uranium to nation's energy security? I mean, we saw U.S. Strategic Uranium Reserve Program, but could we see a more drastic move, like government step up and buy producers or stake in them instead of buying the uranium from the market?
You can. Yeah, well, it's all going to lead to, all that leads to friction, that leads to higher prices, right? So whether they buy it in the market or they go stake, the Eastern players are not going to be able to buy Western companies. The governments won't allow it. I think one of the things I see that kind of, I would say is a little, I think from my perspective, things take time to move, right? So you think about things that are happening strategically. It doesn't happen when people want it to happen right away. But these are all significant tailwinds, right? This has been an industry for the last decade, well, not, the last 12 years that had significant headwinds. Now it's got significant tailwinds and all the dominoes are starting to fall in place. So East will align more with East, West will align more with West. There's more Eastern capacity across the fuel cycle than there is demand, right? If we think about uranium, 65% comes from the East and 65% is consumed in the West. So that's a misalignment. So as everything is, same thing with conversion and enrichment, Russians control 41% of enrichment market, 27, 28% of the conversion market. The market is figuring it out through rising prices, right? Conversion is up 10x, enrichment is up 5x. The markets have a way of figuring out how capital will get spent and when it gets spent. Now, sometimes there's intermittent periods where it needs a boost, right? So maybe it's a little crisis. So let's say you had a little an enriched uranium, the Russians said they weren't going to send a little bit of SWU in, enriched uranium product, or a bill came out of nowhere and said, okay, you're cutting it off today, not tomorrow. there's inventories floating around where you can get some enriched uranium product. So a reactor doesn't run out of fuel. If you had to go to a government, to a fuel bank, but there are some fuel banks around the world. The governments, they're not going to let that happen, I don't think. But all that does is create immense friction with the fuel buyers who panic, right? And as they should. And that drives the entire, everything's interconnected. Uranium, conversion, enrichment. Uranium is a product. In conversion, converts that product, U3O8, into UF6, and then it gets enriched, which is a service. So service prices can't go that much higher without, they need the product to do it. And so they all rise together at different paces. But yeah.
Mike, what about the switch from under to overfeeding? According to some information available, that has not yet taken place. Can you give us your opinion on timing of this? And does the conversion bottleneck prevent enrichers from overfeeding due to a lack of UF6?
Yeah, so it's a good question, right? So if you're thinking about, without getting too technical, underfeeding, to those who don't know, right? It's when you have too much capacity at an enrichment plant, you can use more force. Enrichment is two things: force, which is energy, it's a separative work unit that centrifuges spin, and feed, which is UF6, which is U3O8 converted into UF6. It's those two ingredients. And when it's like an apple press, when you don't have enough, when you have too much capacity, you could just keep spinning the press and you don't need to put in as much apples. If you have too little capacity, you put in more apples to get out the same amount. With underfeeding, when Fukushima went down, you had a lot of excess capacity, right? So you had excess SWU, they underfed it, which meant that they didn't need as much uranium. To put it in context, if a 1 gigawatt reactor with a 4.2% product assay, which is the amount of U-235 content in the uranium, at 0.2 tails, you're probably going to use 511,000 pounds of uranium. At 0.3 tails, so when capacity is tighter, you're going to use 620,000 pounds of uranium, right? So it's actually interesting. Somebody pointed out to me yesterday, some investor was being interviewed somewhere, and they said, well, I don't know about uranium. You don't see many reactors being built. Okay, well, that's not what drives uranium demand. It's part of it. And by the way, there are 55 reactors being built around the world. But put that aside, uranium enrichment capacity determines on the margin, up or down 20%, how much uranium a reactor needs. Meaning, when there's too much capacity, they use less uranium. When there's too little, they use more. So what you're talking about, underfeeding, was a period where there was too much capacity. They were using less uranium per 1 gigawatt to get that enriched uranium product. So the transition to overfeeding comes from tightening capacity. So why does tightening capacity happen? Well, the new contracts that are being signed with enrichment are not going to 10x, the Russians, right? They're going to Urenco. They're going to Orano. The French, Urenco is the Dutch, English, and German conglomerate. The French own Orano. So now all of a sudden their capacity is getting tied up. So when will they overfeed? When that capacity is sold out. Well, why would they do that? Why don't they just add capacity? I just mentioned it earlier. It's been a lack of investment. When centrifuges retired the past decade or 7-8 years, they retired them. They didn't replace them. They didn't add new growth capacity. So you've got all this, you went from excess capacity, you were underfeeding. That underfeeding added 20-25 million pounds per year into the market of uranium. And now you're going to overfeeding. So I see a lot, people ask me, underfeeding to overfeeding. Again, it's another thing. There is no, that's the day it's happening. The tails moving higher are what's doing that. It's the waste stream, right? So the higher the tails, the more uranium you're going to need, and the less SWU you're going to need. Just to put some context around that, where I mentioned that 4.2% product assay, you're probably going to need 175,000 SWU for that 0.2 tails.
Yeah.
If I'm to go to 0.3 tails, I'm probably going to need 140,000 SWU. So I'm using less SWU. I'm using more uranium and less SWU. And so, you know, you are starting to see the underfeeding subside, but Urenco and Orano forward sold that excess capacity, that underfeeding, right? So they've also let their inventories of uranium and UF6 dwindle. So another thing, what I don't see people talking about is, as you transition to overfeeding, you have to add, that means there's more uranium. They've still got to go buy it, right? And so this is a game of brinksmanship. If you're going to talk to Orano or Urenco and say, when are you transition to overfeeding? They'd be out of their minds to tell you, because what they're telling you is they've got to go buy more feed. And then what's going to happen? Their prices are going to go a lot higher. So they're going to say, you know what, we're adding a little, maybe we're not really adding much capacity, or we're still working off some underfeeding contracts. But make no mistake, they're out looking for feed. And so they're out looking for material because they're selling their capacity, right? They're working off the old lower price book over the next handful of years. And now they're starting into to that new capacity, and they're not going to walk away from business, right? This is really, I think, an important point that got overlooked in the bear case too, which in 2014 and 2015, when people were bullish, uranium, oh, the Japanese have to come online. They didn't appreciate the underfeeding aspect of it, that the utility sends in uranium to the enrichment plant. All the utility cares about is the amount of enriched uranium they get. The technology is such within those plants, when there's too much capacity, the enricher can use less uranium, spin it more, as we just talked about, and keep the excess and sell it into the market, 25 million pounds a year. That was the equivalent of the biggest mine in the world adding to supply. And the marginal cost of the enricher was nothing. It works in the opposite now. And so what was a supplier to the market of uranium, Urenco or Orano, in underfeeding, now becomes a buyer of uranium to meet their capacity needs. They can go out, buy extra uranium, and fulfill their higher priced orders. That demand has yet to come. And so when we look at the fuel cycle, when we look at the impact that overfeeding will have, but if they're going to start overfeeding in a couple of years, they're buying that uranium now. They're buying that UF6 now. You know, you're talking, if it was adding 20 million pounds to the market, to now they might need to go out and buy 20 million, 25 million pounds. Higher tails, which it looks like is coming, even more. So the delta from bottom to there could be 40, 50 million pound swing. So again, it's another thing. I can't tell you the day it's happening, but it's happening. And it's all contributing to rising prices.
Yeah, excellent answer, Mike. We saw the news last month where Kazatomprom secured uranium supply contract with major Chinese company. Volumes and specific contract terms were not disclosed. In your opinion, Mike, and experience, what approximate numbers are we talking here? I would presume that is a big deal.
Yeah, I would think so. I mean, they in both deals they did in the last 6 months, they asked for up to half of what they sell for both each one, or produce, I mean. Yeah, look, they have a warehouse right on the border now. My guess is there's a very strong alignment that's occurring. How that works out with Kazakhstan, China, and Russia, how they're going to play in the sandbox together, I don't know. Way above my pay grade geopolitically, how that works. But you just saw them signing a contract with the Middle Eastern utility here at COP28, a big an announcement. All I know is that on the margin, there's less pounds that are making their way into the West, and so you could put them at full production, and even at full production, like I said, we still see very big deficits. But now take that full production and take the many pounds not coming to the West.
Yeah, good point. We hear every year about the incentive price of uranium for developers to step in. It was 70, then 80. Now we are hearing some say $90. What is your take on this? What is the real incentive price for developers to step up?
It depends at what level of bullshit they want to spew to their investors, right? When we first started investing in the uranium space years ago, there's no standard for what they report. There's cash costs, but their all-in sustaining costs could be anything. There's no standard for it, right? So, are they including royalties? Are they including offsite G&A? Are they including sustaining capital? Are they including taxes? Many of them don't, right? So when we're doing that math, it's many multiples of what they're reporting as their true costs. So we used to talk to 2018, 2019, till we were blue in the face. We would talk to the junior miners saying, there's a deficit here. Here's the math. Like we can't be more clear, right? I think I've said this before. I presented at the NEI conference, the Nuclear Energy Institute, in October of 2019. And after that, the chief commercial officer of Kazatomprom called me up and asked me if I could go meet with them in London to talk about our view on supply and demand, because they were following an industry forecaster's view. And Tim Chilleri and I, who works for me, we got on a plane in January of 2020 and flew over and spent a day with them in a hotel conference room, and said, here's the math, and here's what they include. Here's what the forecaster's including, and here's the deficits. And they were like, nope, light bulb moment. And then a couple months later at a conference, they were saying, we're not selling at the spot market anymore. It's fourth grade math. Nothing. I mean, we just happen to be one of the few people around at the space paying attention at the time. Yeah. But the point is, we would say, disclose your real prices. You're doing yourself a disservice, because the fuel buyer is listening to that. So when you're saying, oh, we have a 12, an 18, a 22, a $24 cost, no, you don't, right? Your costs are well into, all in on average across the universe, they're well into the 50s. Into that place, and that's before and regular mining inflation, shortages of sulfuric acid, a lot of different things, different reagents, different things that go up. So, if they're being really honest, and saying what their true costs are, you're running into now, though, Lucian, there's not enough projects. Right. So you can talk, and one of the sources of alpha we think we have is, if I had $1 for every time someone says, oh, this one's coming online, or that I heard this data point, that's coming online. So do the math, lay the math out. It's that simple, but it's unbelievable how it's not contextualized within the context of an entire supply demand model. And there's not the inventories to draw down now. So there is not enough. I think Kazatomprom's even said it. I don't want to quote them, but over the last couple of years, they've said you need two of us. Yes. Right? Yes. They're not making that up, right? That's 80 million pounds. You need those to solve the deficits, right? NextGen's talked about, even they, right? They come out with a big line at the end of the 20s, a big mine. They talk about the same thing. You just got to do the math. So, but there's not enough projects to meet that demand. Now, what we're not talking about, and this isn't in our numbers at all, just this weekend at COP28, there was a pledge from 21 countries led by the US to triple uranium or nuclear power by 2050. That will never happen ever. These guys can't get their shit together. They can't get their act together to finance it and do all that. But so let's say 200 million pounds of demand in the market right now. And I'm thinking we're thinking based on all of our estimates and forecasts that there's 30 plus million pounds per year deficits. And we're bringing on the Kazatomprom at full production. We're bringing on NextGen. We're bringing on Denison Wheeler River. And we still think that it's time that's what those deficits are. So let's say that, and you're going to triple it. I've seen people this week and saying that's 600 million pounds of uranium. Okay, let's say they're wrong by 95%. And so let's say 5% increases. That's a lot of uranium. That would be needed. That's not accounted for. So you need development projects, you need exploration projects to be out there. The prices, look, I could tell you one thing. Again, I said it before, and I sound like a broken record, but history, if it doesn't repeat, it rhymes. And if you're studying cyclical industries and you're not an expert on the past, I hate the term expert, if you're not really studied on the past, it's not going to help you for the present and the future. There was a massive surplus in the market when those fuel buyers took that price from 40 something, $47, $48 to 137. They started contracting like there was no tomorrow when there was a surplus in the market. There are massive deficits in the market right now. And the rubber's starting to meet the road where contracting is starting to meet consumption, and the prices that these junior miners say they are not accurate. They're much higher than what they say, and so we just think that prices will continue to show that friction. Because now, if you're a junior miner, at some point in those negotiations, you're like, well, my cost really isn't 40; it's 57. It's 62, whatever it is. They're going to try and they're not going to tell the utility that, but the market's giving them cover to get higher prices. And so, yeah, we think the incentive price is higher from here. And again, though, you're talking, the incentive price is one thing. The incentive price last time, you needed to get to 60, 65, it didn't matter. Prices went crazy because people waited too long.
Exactly. Mike, let's touch a bit on uranium equities. We have some bigger names like Cameco, NextGen, and UAC reaching all-time highs or nearing that point. But we are seeing that majority of explorers / junior companies did not follow that pace. Do you believe that they will catch up with them?
I think it's all independent of each company is different. Depends sometimes. I don't know. I don't know how they trade really day to day, week to week. I don't know. Sometimes you see money flowing into the ETFs and they go out and buy these things. I think we look at some of them many of them that are we think mispriced. There are some that we don't own. There are some that we've sold. There are some we think are overvalued, a handful of them. There are some that we think are materially mispriced. You've got to do your individual work on it. By and large, we think the entire sector is mispriced. We think it's an industry. It's a supply side that's in crisis. That crisis will be solved by rising prices, right? And those prices will overshoot dramatically. But even if they don't, it's still going to have to move up a lot. Price will be the great elixir. And so when we apply those prices to some of these projects, and we think the market's just not appreciating it.
Mike, where are we in the terms of institutional money? Do you see big money coming in the sector in the upcoming period?
There's some coming in. I mean, we get some calls from. It goes to Cameco, right? That's where the big money.
And NextGen.
Yeah, and NextGen. So we're. As full disclosure, you can see it in our filings. We're a large shareholder of NextGen. We're a top shareholder. For us, the Cameco was a good sized position. Obviously, it's such a big company. We're not as big a shareholder there, but at NextGen, we're a top 10.
Yeah.
So you do see that we get calls. It's interesting. I was speaking to one of the sell side analysts at one of the major investment banks who covers the space, and had an interesting point. He said, I do a uranium 101 for some institutional clients. Spent an hour and a half teaching them, and I think they got it. And we talk, and then I speak to them 3 weeks later, and it's like they didn't understand anything I said. So it's just you got to keep coming back. They come back, and I've said this before, and again, I'll use this term again. People get tired of hearing it, rolling the eyes, but it helps to know how the institutions work, right? Because it's a process. Just like you've got to know their process. So our institutions, when people were asking me 3-4 years ago, are they coming? Yeah, a lot are here. a lot smaller ones, right? Not small hedge funds, small mutual funds, some bigger ones. By and large, are there many more than there were? Yes. Are there a lot versus the universe of investors? It's not even, no. It's a raindrop in a big puddle, right? It's nothing. But there's, so they are starting to get their head around it. They're starting to think about it, but the process by which they work, let's say you're at a hedge fund, you're at a mid-sized hedge fund. What you typically will have is a consultant network that you will use. They have people who look at all different industries. There are firms that go out and find experts in any industry, and they match them up with people looking to speak to them to learn. Hedge funds many of them will use those networks. Yeah. And so you're assigned, here you go. Here, take the file. You're going to look at uranium, your boss tells you, the portfolio manager. Where do I start? You go to the network, you say, get me 3 fuel buyers and 3 traders. And you're paying for that call. And then you speak to 3 nuclear fuel buyers who are very bright people, a lot smarter than I am. And they're the same people I've been betting against since $20 uranium. And we're at 80. And from countless number of discussions with them, I know they're not commercial creatures. They're not incentivized to be, and they aren't. And history proves it, and they're not going to be this time. And they've been telling me since 20, there's all the uranium they can find, and they never have to buy more at anything but lower prices. And they told me that at 20 and 30 and 40 and 50, and now they're kind of saying, okay. At 60, and now they're like, but when they're talking to someone, but they've known me for years. They're talking to someone new. They can say, well, you know what, it's probably temporary. It's just probably a little bump. Prices, there's plenty of uranium. I can find uranium. Because that's what you talk to the average fuel buyer. Yeah, prices go up, they go down. There's they don't do the supply demand work. Do the top ones, the top few do? Yes. Do most? No. And so it's stunning. So they'll be talking to people who will lead them down the wrong path because they're not going to recognize what's happening in price discovery. And then they're going to talk to 3 traders, and they're in their mind, they're thinking, oh, it's like I'm talking to a natural gas trader or an oil trader. These guys have their hand on the pulse of the market. They know what the curve is looking. They know all this stuff. The uranium traders, I'm friendly with many of them. They're very nice, very smart. They have a 2-week time horizon. Completely incongruent with what this guy's trying to figure out or lady is trying to figure out. They're completely different. So they do the math. If they do their own modeling, they see the supply demand deficits. The sell side is starting to come around. The industry forecaster is starting to come around. They're starting to be, the industry forecaster, UXC, is becoming very bullish. Their numbers are starting to come bullish. Yeah. The sell side copies those numbers, not all, but many. Now all of a sudden, the institutional investor is looking at it saying, okay, the numbers are showing there are deficits forming. I talked to a few of these guys, I'm not really sure. And then they go to a couple of conferences, and then all of a sudden they say light bulb goes off. Like, oh wait, these guys aren't incentivized to figure it out. Again, yeah. that's a 3, 4, 5, 6 month process. But are you seeing more? Yes, you're seeing more, and I expect it's going to keep coming.
But what's your strategy, Mike? I know that you were early. Are you deploying new capital into uranium stocks now, or fully positioned, just waiting to take profits from here?
Absolutely not. We're deploying new capital. I'm adding capital to my investment. I've done it twice in the last 3 months. We are. I come in every day assuming I'm wrong. I do that every day for 20, and I've been wrong a lot in my career. As an investor, you're wrong.
Of course.
I came at this in 2015, 16, 17 as a short that couldn't prove you just invert, right? You're just trying to invert every day. In 2016, 2017, the consensus was there's all this uranium. It's always going to be out there. It's not a big deal. Okay, well, so how do you invert that? Okay, well, what's the cost curve look like, and how many of these companies are seeking a profit? And if these profit-seeking companies can't sell well below the cost of production, how many are going to come offline? And then what happens? It's not that complicated, right? It's really not. In seeing where we are, though, I mean, I'm adding new capital that we buy physical uranium in the equities. Absolutely. I've done a couple of junior financings recently, and we buy and sell when I'm selling something. I mean, if something moves to where I think it's a little overdone, I might take a little bit off the table, trade around a little bit. But I keep a good amount of cash around because and I keep more and more cash around than I used to, because as more people come into the space and I see more prognosticators and more people opining and more people being interviewed and more data points, again, I may not be right, but we've been right so far. And when somebody says a number, we probably got it. It's tens of thousands of hours of modeling this industry. Yes. And so when I see people bloviating, prognosticating, and being whatever they're being and talking about stuff that I know is factually incorrect, sometimes they catch us with a little wind and stocks will sell off. I want to have some cash to put to work there. The oddest things will get people off on a little tangent. Like I said, talking about, I don't see demand. Oh, okay, well, where are all these reactors being built? What are you talking about? Do you know how enrichment capacity works? Because that drives on the margin the amount of uranium demand there is. Oh, and on top of that, there's a massive capital cycle coming into the uranium space. So, exactly. Yeah. So no, again, people ask me what inning I don't know. It's earlier than later. But a lot of things have changed, right? So the thing you can't do is have thesis creep. And you can't fall in love with your positions. Just because they're working doesn't mean they're going to continue to work. That's a recency bias. Every day you have to ask yourself, what are the facts? Have the facts changed? If the facts change, then so do my opinions. If the facts get stronger, oftentimes people will say, oh, something is up 4x or 5x. I mean, we sometimes get calls I get calls sometimes from investors in our fund, and they'll say, should we start to take some money off the table? Right, because it's worked. Should we start? No. Well, why would you think that? Somebody might ask. Well, it's gone up a lot. Okay, well, the price doesn't mean anything. It's the value of what we have. Is the value proposition at today's price any different, better or worse than what it was, or the same as the last prices? And so that's kind of how I look at it when I do that work and I do that supply demand work. I think it's as good today as it's ever been for us from a risk reward standpoint. And so, yeah, so we keep putting.
You're adding. Okay, great to hear that. Mike, few more and then I will let you go. You touched on the deposits that will be developed in this decade. Which one do you think that will be developed first? I mean, in the Athabasca, Arrow, Triple R, or Wheeler River? In my opinion, Wheeler River is the only deposit that will be built in this decade. But what's your take?
Look, I think in the history of mining, it's always longer. It's usually, there's always exceptions, but it's usually a lot longer than what people want it to be. Yeah. In my forecasting, I'll take people at their word because that means I'm being conservative, right? If I don't take people at their word for me to be aggressive, I take it so that my numbers are that. Can they look for me in the case of I don't like to talk names, but I think a world-class asset like a next gen is just a globally significant strategic asset. I look at this. You think about what does an energy company do? An oil and gas company provides BTUs of energy, right? Pick a number. Pick ExxonMobil. I mean, it's what 11, 12 billion barrels of reserves. 60 quadrillion BTU of reserves, probably something like that. What's the energy equivalency of next gen's Arrow deposit? Something like 45 quadrillion BTU. So it's something like and I'm rounding numbers here, but it's,
course.
you know, I mean, you're talking on an energy equivalency basis, something the size of a convention center is the equivalent of a $400 billion company's reserves, which go on forever. And so, you know, as long as if I model it as though it's coming online, it's supposed to come online, and I'm still seeing deficits, I mean, to me, that just adds way more value. If they come on later, so what? It's going to come on a little bit later. I don't know. I mean, his history would say these things take longer typically than what they do, what they would like to be.
Yeah, well, Mike, what about Uranian jurisdictions? Which one do you favor, and which one are on your non-investing list?
It's a really good question. So, you know, again, it's at what price? What am I getting? What am I getting paid? What kind of risk am I taking? And what's my upside downside, right? So, is the Athabasca probably more mining friendly, jurisdictionally friendly, and the US more jurisdictionally friendly than parts of West Africa? Yeah, I mean, right, of course it is. Is it more, is it safer? Yeah, yes. Am I going to have Boko Haram come marching into one of my camps in the Athabasca Basin? Unlikely, right? So you're going to pay for that. But at some point in time, there are times where I think there are times where that risk, let's say in a jurisdiction like West Africa, where you're not getting paid to take that risk enough, where, you know, but there's other times where people have run for the hills because of whatever's going on, that things trade to a price where it's just kind of silly. And I'm willing to take that risk. So, you know, I geopolitically, I'm no different than anyone. I mean, who knows? Flip a coin, right? How the world's going to come. Yeah, I have views on certain areas. All things being equal, I prefer to be more in the Western mining jurisdictions, but I'm willing to take a risk if I think the risk reward is such where it's not heads I win, tails I win, because you never know what's going to go wrong. But if I'm wrong, I feel like I'm not paying too much for that. What I won't do, Lucian, is my bets will be smaller there. Right?
Yeah.
So if I'm willing to put 12, 15, 18, 20% of my assets into a company, which we do, it's unlikely to, unless it was trading at such a crazy valuation. I'm only likely to do that in a less safe jurisdiction. I'll size it accordingly.
Yeah, that makes sense, definitely. Mike, final one, M&A. We saw a big merger recently between ISO Energy and Consolidated Uranium. Then we saw some projects consolidation. Today, Boss taking a stake in Anchor Alta Mesa project. Then we had Denison have 15 million investments in F3 Uranium, UAC buying assets. My question to you is, do you believe that we are entering the period where we could see more M&A activities ramping up? And if yes, where do you see that moves in the Athabasca, US, Africa, Australia?
Very good question. I do. I think you'll see a couple of things occur. You know, I think you'll see more entrants come into the space, buyer beware. You got to be careful. New companies will come in, less than 100 probably now. Last cycle there were 500, right? So, and I think it's a much better, fundamentally better cycle now. So you'll see capital will be attracted to the space. Companies will form. I see some of these juniors right now that are being formed, where the CEOs, some of them will talk, and you're like, what are you talking? You don't even know the sector. You just came in here because you got a shell somewhere and now you're in it. So be careful of that. The M&A will occur amongst uranium companies, right? But it's a finite universe. I think what you're seeing, and I don't know the future, I don't know anything other than just strategically thinking. I went back to what's the energy content of a pound of uranium? 180 million BTUs. What's the energy content of a barrel of oil? 5.2 million BTUs. At COP28, there were 50 oil and gas executives that showed up there, I think, for the first time. if you look back at the history of this sector in the 60s, 70s, 80s, 90s, we look at drilling results from all over the place. Oil and gas was all over it. They had massive investments in the uranium sector. It's a period where they're not well liked by the climate crowd, right? So, and what you've seen taking place with the EU taxonomy and countries around the world reversing their views on nuclear, and this I hate the term renaissance, but this rebirth, this recognition that nuclear is a clean, safe, reliable solution as part of that transition. I would be surprised if we don't see the oil and gas complex start to come back into this space, because there's real growth here. Again, there's real money to be made. I also think that they would, by buying a nuclear power company, or a uranium company, who would have thought that that would be a good thing from an ESG perspective for them?
Yeah.
But it would be. And you're seeing it more every day, every week, every month. You hear more and more acceptance of it. So I think that they will start to, and again, I don't know anything. I'm just thinking, trying to put the pieces together.
Yes, yes.
And some of these companies are so big, and some of these mining companies, even though we look at them as some bigger, are so small that they're rounding errors, but really win them a lot of brownie points, a lot of ESG points, and also are meaningful. You can't say a pound of uranium is going to offset a barrel of oil, but on a BTU equivalent, it's serious stuff. So anyway, so that's one thing, and I do think you'll see the major miners, that have been focusing on all the EVs and everything else, and cobalt and lithium and all that stuff. They've got to be out of their minds to be ignoring what's going on in nuclear power and uranium.
Exactly.
And I don't think they are. So I think that's your next wave that comes in, and they'll be competing with state-owned entities. Again, I don't think the state-owned entities, I think, will stay amongst themselves in Canada, the US. They can't come in and buy a controlling stake. But in other parts of the world, they can, and they can in Africa, where all of these oil and big major mining companies are used to doing business. Yeah. So I think that's kind of where strategically, I think where the ball starts to move.
I would have to agree on that, definitely. Mike, thank you very much for this interview. As always, it was a great pleasure talking with you, and I hope we will catch up sometime soon again. Thank you very much.
It was my pleasure. Take care.
Thanks.